Well, thanks a lot to the organizers for including our paper in the program. This is joint work with Vadim Elenev, who's also here. And as most of you probably know, usually Vadim and I co-author with Stein. Not this time around, so really happy that we can get him as a discussant this time at least. Okay, so let me tell you what this paper is about. So the starting point is the well-known fact that the wealthy own the vast majority of corporate equity in the economy. So here you see data from the Survey of Consumer Finances. These are the deciles of the wealth distribution. And you can see that the top decile owns roughly 90% of all corporate equity in the US economy. Then if you look within the top decile, how that equity portfolio is invested, you will see that actually more than half of the equity portfolio in that top decile is invested in private business equity, so not in equity of publicly traded firms. And then from other sources, we know that lots of these private equity positions held by wealthy households are actually very imperfectly diversified. So this paper I'm citing here by Smith, Yagan, Zeider, and Zwick, they use tax records to document how the typical household, the typical wealthy household looks like. And they find that lots of these households are entrepreneurs or business owners that just own a large stake in their own firm. Then on top of that, we know that there's also many investors that own undiversified positions in publicly traded equity. One prominent example here is what Eisfeld, Falato, and Charlan call human capitalists. So they document that large public corporations increasingly compensate their employees through their own stock, and so then that naturally leads to households having exposure or holding an undiversified position in the equity of their employer. So taken together, kind of what these facts tell us is that when we think about equilibrium asset pricing, right, these households in the top decile are probably what we would call the marginal investors in the stock market. And so these marginal investors are probably a lot less diversified than in the standard asset pricing model that we usually write down, where these investors are perfectly diversified. And so what do we want to do in this paper? Well, we basically want to estimate an equilibrium asset pricing model to answer three questions. The first question is, first we want to quantify what are the sources of under-diversification. So why do households hold under-diversified portfolios? And then once we have a model that's kind of calibrated with the correct amount of under-diversification for the representative investor that we see in the data, then we want to know how does this portfolio concentration affect asset prices. And we want to price within the same model both exposure to idiosyncratic risk and exposure to aggregate risk. In particular, we want to kind of answer the question, how does the fact that the marginal investor is exposed to idiosyncratic risk, how does that affect the market equity risk premium on a fully diversified portfolio? And so that's kind of the second set of questions. And then the third set is, because this is an equilibrium asset pricing model with production, we can also think about how this portfolio concentration affects real outcomes in aggregate welfare. Okay, so the first thing I would like to do is give you a little bit of an overview of the key inputs, the key data inputs in the model that we need to answer these questions. And so one important statistic that we really need to know is the exposure of investors to idiosyncratic risk. And one good summary statistic for this exposure is what I call the idiosyncratic variance share. So what do I mean by the idiosyncratic variance share? Well, if you take the return on wealth, on total wealth of an investor, compute the variance of this return, and then calculate the share of this variance that's due to idiosyncratic risk, not aggregate risk, right? And so that's what I mean by idiosyncratic variance share. So then apparently that's a pretty demanding statistic to know, because in order to calculate the idiosyncratic variance share, you have to know the complete wealth of an investor, so not just their investments in publicly traded securities, but also the value of their private business holdings or other kind of assets. And then you also need to know the return on each of these components on each of these components of wealth. And we had a really hard time finding these data for the US, so here we rely on the data in this paper by Bach, Calvé, and Sudini. It's a 2020 AR paper, and they use Swedish administrative data. And so what they find, so what do you see in this graph? So the x-axis, eta tilde, that's the fraction of an investor's wealth that's invested in an individual company. So if eta tilde is 0, then this investor only holds a perfectly diversified market portfolio. If eta tilde is 100%, then that investor has all their wealth tied up in a single firm. And so the first data point from Bach, Calvé, and Sodini that we use here is that the idiosyncratic variance share for perfectly undiversified positions, so all wealth tied up in a single firm, is 76%. So 76% of the variance on the return of these undiversified positions comes from idiosyncratic risk, and then the rest comes from aggregate risk because, of course, even this individual stake is still exposed to aggregate risk. Now, naturally, of course, the investor that invests in the perfectly diversified portfolio has a 0% idiosyncratic variance share. And then maybe most importantly for our model, the average investor weighted by wealth, right? So the average wealth-weighted investor, which will be the representative investor in our model, has an idiosyncratic variance share of 35%. So these are data on portfolios, quantities, how the portfolio is invested. We also need data on prices. And there we just need data basically on excess returns. And here again, on the x-axis is eta tilde, so how much of the portfolio is invested in an individual firm. Apparently, the fully diversified portfolio with eta tilde equals 0 earns the market equity risk premium, 6.4%. And then the question is, how much do investors earn on fully undiversified positions, right? How much do they get in extra compensation for this idiosyncratic risk? Now, there in the data, you really encounter a range of estimates. And we rely there on two sources that come up with what we think are good estimates, and we kind of average them. And we arrive at a number of 13.1% for the fully undiversified position, so roughly double the equity risk premium. Okay, so these are kind of these key inputs into our model. And then our model is going to use these key inputs to estimate parameters and infer these sources of under-diversification. And we will consider two sources of under-diversification. The first one is just compensation for managerial effort. And this has a long tradition in corporate finance. The idea is simply that managers or business owners need to be incentivized by having skin in the game. Right? And the second benefit that we consider is what we call private control benefits. So here simply the idea is that business owners might derive non-pecuniary benefits from being in charge of their business. So this could be on the one hand, Elon Musk buying Twitters, obviously, or it looks like there were some non-pecuniary benefits at play for him. Or it could also be just a small business owner who wants to be their own boss, right? So this is the second source that we consider. Okay, so then as I said, our model will take these inputs and estimate parameters, and I'll return to this graph later. After I've given you some details on the model, I will tell you how exactly we identify these sources. Okay, so then what is the model going to look like that we're going to use? Well, it's going to be an equilibrium asset pricing model with production. There's going to be rare disasters. On top of that, there's firms that have a capital structure choice subject to financial frictions, so borrowing constraints and equity issuance costs. There's going to be two sources of idiosyncratic risk. There's going to be idiosyncratic firm risk, and then there's going to be idiosyncratic human capital risk. And there's going to be an endogenous choice of under-diversification for investors in the model. And so then, we write down this model and we make a set of assumptions such that despite incomplete markets and exposure to idiosyncratic risk, we can aggregate things up to kind of the stochastic discount factor of a representative investor. And so we arrive at a tractable model to study the aggregate implications of idiosyncratic risk. Now, why do I emphasize this here? Because I think it's one of the contributions that we're making because if you just write down this model, it's easy to end up with a model where you have an infinite dimensional state variable or even something more complicated, right, where the wealth of investors kind of becomes the state variable of the model. And then, we know it becomes hard to compute the models, and it's also kind of, sometimes we don't know exactly what we're computing. So in our environment, we know exactly we can compute the rational expectations equilibrium of this model. And so, that's one contribution we're making. Okay, so let me give you a brief preview of the results. So first of all, we quantify these sources of non-diversification. We find that if managerial effort accounts for roughly 4% of GDP, that's roughly what we need to explain the degree of under-diversification that we see in the data. And then on top of that, we find these private control benefits, that they're positive and that they compensate investors roughly for 3 percentage points of excess return. So what that's saying is that if there weren't these private control benefits, then investors would require an additional 3 percentage points of excess return to hold idiosyncratic risk. Then the second question, how does this portfolio concentration affect asset prices? There we find that the exposure to idiosyncratic risk can explain roughly 1% can explain roughly 1/3 of the aggregate equity premium and roughly 20% of its volatility. And it allows the model to basically match the equity premium, both level and volatility, which much smaller disasters than you would have in a model where you don't have this idiosyncratic risk exposure. And this is actually mostly driven by a time variation in this idiosyncratic risk exposure. And then the third question is, how does this portfolio concentration affect aggregate outcomes in welfare? And here we can run a counterfactual where we basically compare this to a counterfactual full diversification economy. In that economy, the risk-free rate would be much higher, the capital stock would be much lower. Households would be willing to pay 4.6% of their steady-state consumption to just kind of get rid of all this idiosyncratic risk. Of course, this is not like a policy proposal or something. This is just to understand the welfare cost. And then, finally, there's an externality in the model, and we can kind of study what optimal diversification would look like, and we find that actually we have a little bit too much diversification still, so by subsidizing portfolio concentration, we could actually increase social welfare. Okay, so now let me give you some details on the model. So this is a production model. As I said, the production function has three factors. There's capital, there's labor, and then there's managerial effort, which is like a special kind of labor. There's two types of risk, aggregate risk. There's a permanent component, basically labor productivity, and then there's a transitory kind of TFP shock. And importantly, these two types of productivity, they drop in a disaster, right? When a disaster realizes, then both of these productivity components take a hit. Firms invest subject to standard convex adjustment costs. They hire labor and managerial effort from households. And then firms receive these idiosyncratic capital quality shocks. So these are denoted by epsilon superscript E. And so if RTK is the payoff to 1 unit of capital after optimal investment in hiring for a firm, so kind of the all-in payoff to 1 unit of capital after you've optimized out all the other choices, then this little epsilon is this IID shock that will multiply the total payoff of 1 unit of capital, right, including its return. This is going to be log normally distributed. And importantly, the dispersion of these idiosyncratic shocks loads on aggregate disasters, right? So in disaster states, this cross-sectional dispersion of these firm-level capital shocks goes up. Then there's going to be financial frictions in the model. So these firms basically can issue safe debt subject to a collateral constraint. They have a tax shield, so that gives them an incentive to issue debt. They also have equity issuance costs. They have a dividend target as a share of their net worth, but they can deviate from this target, so they can issue equity or pay a lower dividend at a convex cost. So we write all this down such that the firm problem is homogeneous of degree 1 in net worth, and then you have these IID shocks, and that means we can still aggregate the firm problem up to the problem of a representative firm. Now, what does the household side look like? Household I, so households are indexed by I. They supply labor and managerial effort to firm I, so each firm is basically matched, or each household is matched to one firm here, right? So it's kind of, think of it as being the owner of that firm or partial owner of that firm. So household I basically supplies labor and managerial effort to this firm, and the labor supply choice of this household is subject to idiosyncratic human capital shocks epsilon HI. Now I want to emphasize there's no large family assumption here. There's no kind of insurance against these like idiosyncratic shock realizations. And this human capital shock permanently basically scales like the lifetime wages of this household when it hits. And then households have a portfolio choice. They can buy the bonds that are issued by the firm, and they can put together an equity portfolio. And in particular, they can decide on a weight, eta, that they invest in a single firm. So part of their portfolio, they always invest in this individual firm. And then the remaining part of their portfolio, they invest in the perfectly diversified market. And firm I's manager maximizes the firm as if this firm was fully owned by household I, right? So that's an important assumption we have to make here in this incomplete market setting. We kind of have to take a stance on what the SDF of the firm is. We're assuming that the firm manager maximizes or runs the firm as if it was fully owned by this household who holds the undiversified stake in the firm. And so then we also allow that firm I's capital and household I's labor shocks can be correlated at the micro level. Now, why do we see portfolio concentration in the model? As I said, as I already previewed, there's two sources of this. The first one is managerial effort. So in order to supply any sort of managerial effort, a household has to take an undiversified stake in the firm. That's kind of just hardwired. And then households can also receive utility, potentially. If the psi parameter is positive, then households can receive positive utility from holding this undiversified stake in a firm. Okay, so then, the key model features that we specified allow us to basically achieve aggregation in portfolio shares. So even though these households might have very different levels of wealth and consumption and so forth, they're all identical in terms of shares, right? So each household will choose the same consumption to wealth, ratio, and each household will choose exactly the same portfolio shares. So we can basically aggregate the model in shares. And so this is kind of like, if you want, this is kind of like Constantinides and Duffy, but extended to a production economy and with all these other features. And so what we end up is basically the SDF of a representative household has like all these common terms because it aggregates in shares. And then, it has this is the growth rate of wealth of this household. And that growth rate of wealth will depend on the idiosyncratic shocks and also on the degree of portfolio concentration on that household. But since that is IID, right, basically we can still aggregate this up to like a representative investor. And then we can use the stochastic discount factor to kind of price any asset in the economy. Especially we can price a portfolio with any sort of exposure to idiosyncratic risk. Now, of course, in equilibrium, only one portfolio will be traded. All right, that is the portfolio that that all the households are going to be choosing. But we can basically price a continuum of assets on this whole interval between 0 and 1 on portfolio concentration. And here you see basically what the first order condition looks like, right? So this is the price of the portfolio, and here you see kind of the loading of the portfolio on idiosyncratic risk that multiplies this this epsilon exposure. And this is the stochastic discount factor you see up here. So you see both the stochastic discount factor and the payoff will depend on the idiosyncratic risk. So the idiosyncratic risk is going to be priced. And then you see here also, this is basically this non-pecuniary benefit that households could receive on the margin for holding idiosyncratic risk. All right, so this is what I was going to show you about the model. Now let me talk about some results. So first I will return to this plot, right? So this is a plot I showed you in the beginning. And now I can kind of tell you how the model basically infers, these degrees of non-diversification. So first of all, there's the parameter alpha O. If you remember, alpha O parameterizes the kind of Cobb-Douglas share of managerial effort in the production function of the economy. So if alpha O is larger, right, then households will be incentivized to take more idiosyncratic risk because they need to take this idiosyncratic risk in order to have incentives to provide managerial effort. And so we find that an alpha O of roughly 4% is what we need to kind of match the idiosyncratic risk exposure of the marginal investor in the economy, right? So we basically line up this dot here, which is the on average exposure of the investor or the share of wealth invested in a single firm. We line that up with this variance share. We also line up this point up here, right? So this is basically the exposure of a fully undiversified, fully concentrated portfolio to idiosyncratic risk. And that's in the model determined by the relative quantity of idiosyncratic versus aggregate risk, right? We also need to get that right. Okay, so that's kind of the first piece that we kind of identify. And then the second piece is how big are these non-pecuniary benefits? And we find that they're positive. Now the parameter itself doesn't have like a clean interpretation, right? It's just something in the utility function. So to kind of shed light on that, what we can do is we can just solve the model after we've estimated it. We can just solve the model again and set the psi to 0. So we can just get rid of these non-pecuniary benefits. And then we could see how these lines would look like in this like counterfactual model. And what you can see here is then this line here, basically this return line. So how much return investors require for idiosyncratic risk, that shifts up, right? And so the difference here is 3 percentage points. And that's what I said, that without these non-pecuniary benefits, households would require an additional 3 percentage points of return for holding idiosyncratic risk. Okay, let me give you a few other highlights about the calibration/estimation. I don't want to go through all of it, but because we have this idiosyncratic risk, we can basically, match asset prices with smaller, less persistent disasters. In particular, right, if you know the kind of prior literature on disasters, even the Great Depression was kind of like not bad enough to be counted as like a real disaster in most of these models. So because we have these other features, we kind of get away with much smaller disasters. In particular, we kind of have a disaster in sample if we include the Great Depression. And so we can kind of match the model moments to that partially. This spike in idiosyncratic dispersion during disasters is basically, we estimate that from stock return dispersion over time. The model can then match the equity premium, both the level and volatility and the risk-free rate level and volatility with an intertemporal elasticity of substitution of 1/3. and a relatively moderate degree of risk aversion. In particular, as you can see here, we don't need like a large IES to match these to match these asset prices, and there's only a small amount of preference for early resolution of uncertainty. Financial frictions help us to generate a high volatility of equity returns, but a low volatility of corporate equity payouts. So there's no kind of excess volatility puzzle in this model. And I should point out that the model does produce a wealth distribution, right? So even though the wealth distribution doesn't matter for anything aggregate, it exists. So we can solve a model, an extended model with perpetual youth and some mortality where basically there is a determinate wealth distribution. And that wealth distribution generates quite some inequality, but not enough, not as much as in the data. And the differences arise because in the model, basically households are all ex-ante identical. We have egalitarian redistribution of bequests, and human capital is counted as part of wealth. So these are all things that make wealth less unequal in our model than in the data. Okay, now finally let me get to some results about how the presence of idiosyncratic risk actually affects asset prices in the model. So what I'm varying here in this graph on the left is alpha O, right? This is how important managerial effort is in the economy. And so if alpha O goes up in the model, then also will the share of idiosyncratic exposure, right? So how much households invest in a single firm. The dashed line is the model estimate, right? Okay, so what will happen with the excess market return? So I should be clear, this is the return on a fully diversified portfolio. This is the equity risk premium in the model. So as you increase alpha O, this equity risk premium rises a lot, right? So a lot of the increase in the equity risk premium basically can be explained through idiosyncratic risk exposure. And why does that work, right? Because in general, if it's idiosyncratic risk, why should it affect the return on the fully diversified portfolio? Well, it's because if households or if these investors are exposed to idiosyncratic risk, and this idiosyncratic risk goes up during disasters, basically, right, the cross-sectional dispersion of idiosyncratic risk becomes aggregate risk. And so if I solve a counterfactual model where I make the cross-sectional dispersion of idiosyncratic risk constant, so if I get rid of that time variation, you see that this line becomes a lot less steep, right? So a big part of the increase in the equity risk premium is basically because of time variation in idiosyncratic risk exposure. Now, even when I make it constant, though, you still see that this line is upward sloping, and that has to do with the fact that the endogenous choice of idiosyncratic risk exposure is time varying as well. And then there's this nonlinear effect on the volatility of the market return. It's too hard right now to explain exactly where this is coming from, but let me say that basically what's happening is that when you increase in general equilibrium, when you increase idiosyncratic risk, then endogenously through the choices of households and firms, aggregate risk actually goes down. Okay, now what about effects on real outcomes? Well, the first thing that we see is, so what we do here is basically we solve the model. The baseline model is the model that I just showed you where everything is calibrated to match the data. You get a low risk-free rate. You get a high excess return on capital in the firm. This is the total discount rate that the firm will have to apply to physical capital. Okay, so now we can solve two other models. One where we get rid of the time variation in this cross-sectional dispersion of risk. And one is the full diversification model where we get rid of all these model features that cause households to choose idiosyncratic risk exposure. So what you can see is if we go to full diversification from the baseline, then the risk-free rate rises by something like 6%. So that means there's like a 6% precautionary savings motive that's induced by this exposure to aggregate risk, so quite big. At the same time, risk premia really decline, right? So the excess return required on capital goes down from something like 8% to something closer to 3%. Now, the total discount rate that the firm applies to capital is basically the sum of those two, and that actually goes up. And so then in the model with full diversification, the aggregate capital stock is actually smaller. Now, what about effects on portfolios? Well, obviously, when I go to full diversification, the risk share, the idiosyncratic risk share of the portfolio goes down to 0. If I get rid of time variation in idiosyncratic risk, the idiosyncratic risk share would actually go up. Consumption growth volatility in the sample with disasters in it is much higher in the model with idiosyncratic risk than without. And one thing we can do is basically we can calculate in this model how much households would be willing to pay to kind of lay off all this idiosyncratic risk they're exposed to through their ownership of these undiversified stakes, right? So the question is here, again, this is not a policy proposal, but the question is just like, how much would households be willing to pay to be in a world where they could just get rid of all this idiosyncratic risk? And it turns out that these welfare costs are large, and households would be willing to pay almost 4.6% of their steady state consumption to just kind of like get rid of this idiosyncratic risk. All right, so then the final thing I'm going to show you, and this is kind of a complicated thing to explain, so I have to take some time, is aggregate welfare. So in order to figure out whether the degree of non-diversification that we see in the model, if that's socially optimal or not, we kind of introduce a thought experiment here. We introduce a tax or subsidy on managerial income. Again, this is not meant to be a policy, but this is just to kind of understand what the optimal level of non-diversification or portfolio concentration is in the model. And so this is basically this tax on managerial income. That's what you see on the x-axis. And then you see several model outcomes if you kind of solve the model, all parameters as calibrated. The only thing that we kind of vary is this managerial effort, this tax on managerial effort. So what you see is as you increase this tax on managerial effort, then in this model of the version here, in the blue line, this is a model solved without any financial frictions. You could see that households choose, right, they choose less concentrated portfolios, so they choose a lower level of ADA, they invest less of their wealth in a single firm. That makes sense. And then the capital stock in the economy actually rises, right, and aggregate welfare goes up. Now, why is this? It's because in the model there's an externality that households don't internalize, that if they choose a more concentrated portfolio, they affect the stochastic discount factor of the firm. And because the firm basically becomes more exposed to idiosyncratic risk, this firm will choose less investment and just kind of be smaller, and households don't internalize that. So if you kind of penalize, in this baseline version of the model, if you penalize diversification, then the firm SDF becomes less exposed to aggregate risk, and aggregate welfare goes up. Right? So that's this first externality, is just kind of households don't internalize the effect of their choice of ADA on the stochastic discount factor of the firm. However, it turns out that when we solve the model, with financial frictions, this effect gets turned on its head. So if you solve the model with financial frictions, then there's this equity issuance cost and a borrowing constraint, and those kind of limit the optimal size of the firm. And then we basically get too much diversification in equilibrium. So what we actually would want is we would want the firm's SDF to have slightly more exposure to idiosyncratic risk, which would shrink the firm a little bit and make these financial frictions slightly less severe. And then actually, so the combination of this externality together with financial frictions means that we want to subsidize, portfolio concentration a little bit, and welfare is kind of maximized at this point, which is some sort of 16% subsidy on managerial income. So what this is all highlighting is that, like, in this model, that actually is relatively simple, right? I mean, like, at least for like the models that I usually write down. There's actually lots of things going on. There's like these externalities, and it's actually not obvious, what the kind of right degree of portfolio concentration or diversification is. Okay, so let me conclude. So we built this production-based asset pricing model with endogenous under-diversification that prices both aggregate and idiosyncratic risk, kind of in the same consistent setting. We use it to quantify the sources of under-diversification in the data, and we find that 58 to 87% are needed to incentivize managerial effort. So if managerial effort accounts for roughly 4% of GDP, and in the paper we look a little bit, at if this is consistent with the amount of like management or executive compensation that we see in the data, and it seems to roughly line up, then we can explain the amount of under-diversification that we see. And there's also this private benefit of control, so it seems like business owners like to kind of be in charge, or they get some benefits from being their own boss, and that compensates them for roughly 3 percentage points of annual return. We also show that idiosyncratic risk matters for asset prices in the macroeconomy, so more than a third of the public equity premium, so the perfectly diversified market equity premium, is due to idiosyncratic risk in the household stochastic discount factor, and the economy with full diversification has lower risk premium, a higher risk-free rate, and a smaller capital stock. And the welfare cost of bearing this idiosyncratic risk for households is equal to 4.6% of consumption, Yet in our calibrated model, there's actually even bigger benefits of non-diversification. So that means there's too little portfolio concentration in equilibrium. All right, thank you.